Remember the saying, cash is king? But is it? If you had $100,000 in your portfolio, would you keep it in cash, buy bonds, or own short-term treasuries? No waiting. As always, I'm giving it to you up front. I prefer short-term treasuries because they're just less risk and high liquidity. But before you move your money anywhere, there's something important you need to know. In this video, I'll show you two ETFs that have outperformed many traditional bond and treasury ETFs since 2022. And one of them may surprise you. It sure did surprise me. Let's cover cash first. I know it feels safe because the balance is unchanged. The problem? Inflation. If inflation is 3% and your cash earns 1%, your purchasing power is shrinking every single year. Cash protects against market volatility, but it doesn't protect against inflation. But what happens when you want more income without taking significant risk? Most investors know BND. This ETF owns thousands of government and corporate bonds and provides income with diversification. The challenge is that bond prices can fall when interest rates rise. This is what we saw in 2022. Now compare that to another ETF, BNDI. Since August 2022, BND yield 4%, total return 11.8%, while BNDI yield 5.8% with total return 16.59%. Same asset class, higher income, higher total return, but also higher management fees. There is another difference most investors overlook, is taxes. BND income is generally taxed as ordinary income in taxable accounts. BNDI uses strategies that may benefit from Section 1256 tax treatment, where gains receive a blended 60% long-term and 40% short-term capital gains treatment. For investors in taxable accounts, that can improve after-tax returns. So if BND has more income and higher return, what about alternative? Is there any other? Now let's look at short-term treasuries. SGOV invests in treasury bills maturing in just a few months. This ETF benefits investors with very low volatility, high liquidity, government-backed securities. Current yield is approximately 3.85%. Now compared to ETF CSHI. Results through mid-2026, SGOVs yield 3.85, total return approximately 16 to 17%. CSHI yield 4.7%, total return 22.49%. Again, higher income and stronger total returns over the same period of time. SGOV's income comes primarily from US Treasury bills, which are generally exempt from state and local income taxes for US investors. CSHI combines Treasury exposure with an option strategy that may qualify for Section 1256 tax treatment, potentially improving after-tax returns in taxable accounts. So while SGOV remains the simpler and lower-cost choice, CSHI has historically generated higher income and stronger cumulative returns. Now let's translate those percentages into actual dollars. We'll make it practical. Cash is unchanged, but is facing devaluation against inflation. BND at 4% with income $4,000 a year, BNDI at 5.8% with income of $5,800 a year, SGOV at 3.8% with income $3,800 a year, CSHI at 4.7% with income $4,700 a year. Annual MER cost on $100,000. Those are important. BND $30, BNDI $580, SGOV $90, CSHI $380. That's a difference of thousands of dollars in income, but also hundreds of dollars in fees. One important note, all yields and total returns discussed in this video are reported after MER fees have already been deducted by the fund. In other words, BNDI and CSHI didn't outperform BND and SGOV before fees. They outperformed them after fees. That's why net results are what matters the most. The goal isn't to find the lowest cost ETF. The goal is to keep the most money after all the deductions. When I choose income producing investments, I consider first, risk, second, net income, third, total return, Fourth, impact on taxes. 5, management fees. For my preference, SGOV and CSHI remain my preferred risk-adjusted choices because of their simplicity, liquidity, and reasonable safety. So where would you put your next $100,000? Traditional cash, bonds, treasuries, or one of the alternatives? Here's a short disclaimer. This video is for educational purposes only and not financial advice. Always do your own research before making any investment decisions. I'll see you at the next one.